How are you?
Good, thank you.
Thank you.
Okay, thanks. Good evening to everybody. Welcome to the Pension Board meeting. We'll call the meeting to order at 7:04. And we'll jump right into our agenda. Our first order of business is public participation, and we'll note that we don't have anybody here, so we'll move on with that. Next item is to review and approve the minutes from our special meeting of September 27th, 2021, which I believe that the draft of the minutes was sent out to everybody, so hopefully you had a chance to look at them.
Motion to approve the minutes of September 27th, 2021, as submitted. Special meeting.
Thank you. Mitch, is there a second?
I have just one question on the minutes, if
we
I
could have a
might.
second?
Second,
Okay.
in the discussion, here I go.
Discussion, there you
Okay.
go.
When the meeting re-adjourned after executive session, should the minutes indicate that Ryan Ahern and Jeff Fernandez did not rejoin the meeting, or is that irrelevant?
Well, I wrote that he recused himself and left the meeting.
Right, but it's just when we re-adjourned, they didn't come back in again, and I don't know if that should be reflected. Just a thought.
I don't think it's necessary.
Okay.
I don't think it's necessary, but...
Okay.
So we have a motion and a second. Any other questions or comments? If none, all in favor, signify saying aye.
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 Any opposed? Thank you. And just as a reminder, if you have to speak, please make sure you push the button in front of you so that everybody can hear you. Next on our agenda is we have our proposed meeting schedule for 2022, which the dates were sent out. We tried to keep it in line with what we've been doing, which is meetings February, May, August, and November. The preliminary is the third Thursday of each month. Does anybody have any questions or issues? Nick?
Yeah, Eric, if you don't mind, the May 19th meeting, besides being somebody's birthday,
Yeah, well, that's true.
that's our chairman, for those that don't know. I also will be out of town. It's a graduation weekend. I will not be able to attend, so I was going to see if we could make it either the following Thursday or the Thursday before, if that was okay. Otherwise, I just won't be here for that particular meeting.
I mean, the following Thursday gets us, I think, into Memorial Day.
Memorial Day weekend.
Okay.
It's just before, so, I mean, we could go earlier than the week earlier. I guess my question is, Chris, would you have a problem if we made that meeting May 12th?
No, that'd be perfectly fine.
So then why don't we,
Is that okay with Rebecca?
if
and
that's okay
Barbara?
with,
You okay? All right, so I'll make a motion then that we approve a meeting schedule for Pension Board with the following meetings in 2022. February 17th, May 12th, August 18th, and November 17th.
Second.
any other questions or comments? If none, all in favor?
Aye.
Aye.
Aye. Any opposed? Nope, so meeting's schedule is
Thank you.
passed as adjusted. So moving right along, next we have our friends from Mutual of America, Pam and Andrew, as they've done in past years in November. So we always look forward to seeing you. So at this point, Pam and Andrew, will turn it over to you. And again, as we said, you have a microphone there. If you could just make sure you push the button in front of you so the light's on when you're speaking.
Oh, perfect. Okay. So I think, hi, I'm Pam Genty, and we provide the 401A plan here. Can I put my mask down? For the town of Orange. And what we're going to do tonight is basically what we do, every year. Andrew's going to start out with his benchmark and performance report in regards to how the portfolio is doing as a whole. And then I'm going to finish with the benchmark.
Great. Well, thank you, everybody. It's nice to be here. I haven't done many in-person meetings, but it's a nice change of pace, to be honest. I get tired of doing virtual meetings from my basement. So if you could turn to the first page, I thought what I would do is just give you an overview of the market, because it's always interesting to know what's going on in the market. As you can see, this is quarterly returns. You'll see on the left side, for the quarter, the S&P was up 0.6%. And when you look at the right side, you'll see the S&P was up 15.9%. So pretty good returns on a year-to-date basis. Notice that MSCI EAFE, which is international, down 0.5% for the quarter, but it's up 8.4%. So again, good year so far, but U.S. markets are better than international markets. If you look at emerging markets, down 8% for the quarter, and emerging markets is down 1% for the year. And on the last one is the Bloomberg Aggregate. That's the index of fixed income. It was flat for the quarter, but notice on the right side it was down 1.6% for the year. So the index year-to-date is down really due to rising interest rates. As I think we've all read in the paper, there's inflation. Some might call it transitory, some might call it structural, but it seems to be around for a while. Wages are increasing, and that is really putting pressure on bond prices. So when interest rates rise, bond prices go down. If you turn to the next slide, let's talk a little bit about U.S. equity performance. On the left side, you see we break out the U.S. market into large cap stocks, mid cap, and small cap. On the top, we break out style into value, core, and growth. So notice for the quarter in the middle, if you go to the middle, again, the S&P was up about 0.6%, but notice that both mid cap and small cap stocks were negative. So what that really says is investors gravitated towards more large cap stocks than small cap stocks, because small cap stocks are more sensitive to the economy, and with disruptions in the supply chain, that causes a lot of issues. So investors felt more comfortable in large cap. The only style that's actually up was the Russell 1000 Growth. That was up 1.16%. And that's really comprised of most of your tech stocks, Google, Amazon, Facebook. Notice the Russell 2000 Growth was down 5.65%. So again, for the quarter at least, investors shied away from small cap. If you turn to the next page, this is on a year-to-date basis. So the S&P was up 15.9%. That's in the middle box. A little higher than mid-cap, but better than the Russell 2000, which is small cap. So year-to-date basis, large cap has done better. That's the trend that happened in 2020 when large cap was better than mid cap and small cap. It sort of reverses a trend that happened the first quarter when small cap was doing better. If you look at what's been the best style, it's actually been the Russell 2000 Value. So think of those small companies in the United States that are more value-oriented, that are very susceptible to the economy, industrial companies, those type of companies, leisure companies. They have rebounded because they took a hard hit in 2020, and they've rebounded as the economy has opened up and vaccine rates have increased. Also notice that the Russell 1000 Value Index on the top, that's greater than the growth index. So again, investors overall in 2021 gravitated towards large cap value. Think about airlines, hotels, financials. Those were, again, the stocks that got beaten up in 2020, and they've sort of rebounded from their lows. Any questions on the economy? if you turn to next page, so what I'm going to do is, because we've done this every single year, let me just go into the summary, and then I'll talk about some specific funds where you have the most assets, which I have, which Pam supplied it to me. But when you look at the page 4 and all the funds, there have been really no changes to the funds. Everything is sort of status quo. No additions, no deletions. Now, when you turn to the next page, what I always go over is how we monitor funds. So there's a committee made up of 9 members. Their responsibility is to meet with the managers twice a year in person in New York. Now, obviously in 2020, that hasn't happened. We've done WebEx meetings, and we've continued that in 2021 so far. But they've worked out well, and we still have great access to the managers. And again, the way the committee looks at things is philosophy. What's the style of the funds? Is it appropriate for a retirement plan? So again, no sector funds, no Bitcoin, no gold. They might be good funds for your personal money. They're not appropriate in a retirement plan where ultimately the town of Orange is the fiduciary. We look at process. How does a manager buy and sell stocks? But to me, the most important thing is expectations. When is your manager going to do well? And when is your manager not going to do well? And a lot of that has to do with style. So if growth is in favor like 2020 and all the tech stocks are doing extremely well, you'd expect a growth manager who's very aggressive to do very well. And that's been the case. If a manager is a little more value-oriented, they'll do well, but not as well. So the point is that if a manager actually does way better than we think, that's probably an issue. Just like if a manager does poorly and they're supposed to do better, that's an issue. It goes both sides. We don't want our managers straying from what they're supposed to do and taking undue risk. That's not what it's about. We look at people again. The portfolio manager, the sector analyst, is there stability? Is there experience? What's going on beneath the covers? We look at price, and I'll show you again the chart on price. And the point to make also is that the funds that you have, and I should have done this on the previous page, are the same funds that every client has and the same funds that everybody at Mutual America has. So I don't have, Pam doesn't have, we don't have any different funds than you do.
In our own plan.
In our own plan. In fact, if you look at the investment fees, they're exactly the same too. So if one of your participants is in the Contra fund, and I think it's 62 basis points, if I go into Contra, that's what I'm paying. So you never need to worry that does a larger client have better fees? Does our provider have better fees than we do? On the investment fees, that's not the case because all the fees are exactly the same. And then we look at performance. Any questions? Let's just skip to, I might skip to page 7, the Morningstar ratings. You know, there's a couple of ways to measure quality. In the book, I put in the net percentile rankings to look at, but I think sometimes understanding the ratings is slightly easier. So Morningstar rates funds 1 through 5. 1 is the worst, 5 is the best. And this is a summary level, and we can show you the individual funds if you'd like to see. But when you look at 5 stars, the average is 10%. We're at 6.5%, a little bit less. But notice on 4 stars, 37% of our funds are 4 stars. The average in Morningstar, or our peer group, is 22.5, so we're much greater. If you look at 3 stars, we're at 39% versus the average of 35%. We don't have any 1-star funds. Now, when you look at 2-star funds, 17% of our funds are 2-star funds versus the average of 22. So it's a little bit better. Now, Morningstar changes their ratings every month. This is as of September. As of October, that number has dropped down to 10%. And I will say You also need to understand how Morningstar does ratings. For instance, the Vanguard fixed income portfolio is an index fund. It's a 2-star fund. So the question is, why is an index fund 2 stars? It's because active management has done better than indexing, which is always true in fixed income. But that doesn't mean it's really a 2-star fund. It's just the wrong universe. They're mixing indexing with active management, and that's the wrong metric. Now, we've gone to Morningstar a couple times. Morningstar is a great company, large company, but you tell them something and it just sort of is the way it is. So you have to sometimes understand the nuances of how they actually do readings. Any questions? One more summary slide before I talk a little bit more about specific funds. Let's talk about fees. So what we're showing here is the investment fee of the platform, funds on the platform versus our peer group. And the investment fee is actually called the net expense ratio. So what we do is, using Morningstar, they rank funds 1 to 100. 1 means the lowest fee, 1 means you have the highest fee. So this is a summary table, but what they do is take Contra, which is large cap growth. They compare the fee of Contra, the investment fee, versus other large cap growth funds. Take the Mutual America 2050 funds. They'll take that and benchmark it versus other 2050 funds by other providers. So this table is at a summary level. So when you look at it, 34 funds are in the top 20 percentile. That means that their fees are lower than 80% of their peers. 7 funds are in the percentile 21 through 30. That means those 7 funds have fees that are lower than 70% of their peers. And then when you get to 71 through 100, there's essentially 0. So what this kind of shows you is, well, everybody has the same fees. That's part 1, which is good. Part 2 is, are those fees competitive in the marketplace? And this shows you that the fees are competitive and actually low compared to other funds that you can get. Any questions? Wait, where's my pen? I'm sorry, what's that? Actually, what did I do? Right. So what I'd like to do is maybe just talk about a couple funds. So let me talk about Fidelity Contra funds. It's not in the book, unfortunately, and I'd like to hand out this book next time, but it's still with legal. And actually, what I probably would like to do is, it's about 160 pages. The thought is maybe that we should get some tablets, put it on a tablet, hand out the tablet so you can use it, and then after the meeting, take back the tablets. Does that sound like a good idea, bad idea?
Or just, you want to send, you can send this as
A PDF?
PDF.
Yeah, we can do that too. I think what I'm trying to get away from is paper. Thank you.
Good idea.
And I'm so used to now doing virtual, to be honest, that in virtual, which we did, I think, last year, I can pop from one screen to another screen. So I'm sort of learning as we go.
Yeah, so if you have tablets to bring us next time, that would work fine.
Or we could bring the computer and put it up on the screen there, too.
The only problem with that, by the way, is you get into all these security issues. You know, I know there's security issues, I can put it there, then I know there's connection issues. So the last thing you want to do is come once a year and spend an hour on connecting up your... So Contra Fund has about $4.1 million. It's about 14% of the portfolio. According to Morningstar, it's a 3-star fund, but it has very, very competitive returns. So again, Contra Fund, 60% is managed by Will Danoff, 40% by Gene Park. So it's very growth-oriented. Some of the top 10 holdings are Microsoft, Alphabet, Amazon, but it has a slightly value tilt for a growth fund. So a little less conservative than another fund. But when you look at the year-to-date numbers, the fund is up 15.78% on a net basis. Slightly below its index, but when you look at its Morningstar peer group, it ranks 17. So again, 1 is the best, 100's the worst. So it's done very well on on a year-to-date basis. 1 year, it's up about 24.98%. When you look at 2020, it was up 30.57% and actually ranked in the 60th percentile. So it shows you that it did extremely well, but that slight value held it back ever so slightly, but not that much. And in 2019, it was up 31.58%. So the fund is sort of delivering what you would expect in a large cap growth fund. Any questions? The other fund that seems to have somebody is the Vanguard International Funds. It has about $1.6 million. And, hold on. And I am not used to flipping through a book anymore.
Randy, what you're saying is the funds that you're talking about now are ones that our employees are investing in?
Yes.
Okay. They're not just funds that you have, they're ones that we're showing
No, right,
investment in.
right. So Contra Fund has invested $4.1 million, and that's 14% of assets. So when you look at the Vanguard International, another strong fund has about $1.6 million. It's growth-oriented. Just let you know, this is where style makes a big difference in the market. Growth has done well, but internationally, growth hasn't done as well. This fund has 80% in developed markets, 20% in emerging markets. So it has exposure to China. So when you look year to date, it's up 1.1%. So you see international hasn't done as well as the US. However, if you look at the 5-year annualized number, it's 19.47%. So very, very strong performance. Growth was in favor internationally. Over the last year, the markets begin to rotate. Now in 2020, this fund was up 57%. So you would expect after a return of 57%, you wouldn't have such a strong return. In fact, in 2019, it was up 31.2%. So strong returns. We are watching it, but again, we know it's growth oriented. Style makes a huge difference.
But it seems to indicate that they've had consistently 5 stars from Morningstar. I'm looking
Correct.
on this. So, I mean, that would be strong comfort to.
It's very strong comfort. The only reason I bring it up is I want to make the point that we watch the style of the funds. And when the market's in your favor, you do extremely well. Sometimes when the market's not in your favor, you won't do as well. And sometimes you get a little bit of pushback from people that say, this fund isn't doing well this year. And you're sort of like, well, it's done well over the last 3-5 years. It can't do well every single year. And the other thing, just maybe lastly, is the target date funds. You also, I forget how much.
It's about a $3 million exposure in the target date.
Yeah, it has about 11% exposure. They're doing, extremely well. Again, our target date funds are a mix of indexing and active. So most of the indexing is in U.S. equity. Within, a big portion is the S&P 500. Another big portion is the mid cap. So we believe in indexing because 1, you get broad market participation, and 2, with indexing, you get very low fees. And that's why our funds have low fees. We believe in active and fixed income, because I mentioned Vanguard is a 2-star fund because it's an index fund. Active is much better, and typically active is better in small cap. Now, just to point out one fund, you have about $650,000 in the 2035 funds. Now, the 2035 funds has about 75% equity, 25% fixed income. Year to date, it's up 10.8%. Over 1 year, it's up 25.5%. And I think the most telling stat is that in 2020, the fund was up 12.6%. So when you think about probably the most craziest, wildest years, probably since the Great Depression, if you were in this fund and you did absolutely nothing and you didn't know anything about investing, you're still up 12.5%. So I think that's where target dates actually do what they're supposed to do. And not just in Mutual America, but overall, I think over 50% of new flows are going to target date funds. That was a pretty quick, maybe brief synopsis, but does anybody have any questions?
Just on your last point, Andrew, doing this, as people know, I do in Guilford when I have people come into similar defined contribution funds. It does seem that most people, especially young people, just want to go into the target funds because they don't have a financial advisor, they don't have the wherewithal to figure out what to do. So that seems to be the backup plan, if you will. And it's nice to hear that funds like that are doing well, the target funds.
Yeah, just, in fact, especially maybe my older son who's 26. So when he started working, he actually asked me for advice, which is unheard of, to be honest. And I told him to put as much money as he could, contribute and put into a target date fund and do nothing. And if you do that, you should be well off in retirement if the market continues to do what it's supposed to do.
I'll just remind everybody that Mutual, one of Pam's proteges, I'll call her, comes out twice a year, once in the spring and once in the fall. And we set up half-hour meetings for any of the employees that want to.
Yeah, Lana.
They give them advice. They also have phone numbers that they can call at any time to talk to the people up there on investment advice.
That's very good.
Actually, that reminds me something to ask, or I guess add about that. The last time that Lana came through, I had sent an email out to my membership and also the people in the library. And a lot of people scheduled appointments, and they were very happy about that.
I think it was the first time, I believe it might have been the first time that it ever got down to them, even though we did send an email out to somebody over there to distribute it. In the future, I'll sure make sure it goes to you so it gets distributed.
I've never had an appointment myself, and I had called to schedule one, and they were all full, so
Yeah.
I think that's...
We'll catch you in the spring. I'll make sure that.
I've been here 11 years, and I haven't had one yet. I'm doing okay. And it's nice to hear that the target date funds are doing well, because that's what I'm in.
So are you done? Okay. So, again, every year, Andrew kind of gives you a picture overall and talks about specific funds that, need attention or do not, that are doing well in your portfolio. And then I take it a step further and I go over more of a customized benchmark report to see where your plan stands in the universe with all the other plans based on the assets, number of people, the allocations. So we're just going to go over this briefly. We'll pass this over here, pass a couple here. Give that to Chris, and actually, you know what? I'm going to give it to that gal too over here. Okay. Okay, so, well, again, I'm happy to say everything's up on a positive note. This report I ran as of October 28th, and right now, the plan assets are approximately $29.3 million. So that's great. It's growing. Your next, right now, your annual separate account expense fee is 0.35%. Your next break point will be at $50 million, and then it will drop to 0.25%. So again, this benchmark fee report is one of the tools that we use, to measure your plan. It's customized, and it basically calculates the dollar-weighted average of all your plan expenses, your fund expenses, I should say, to get a ratio of plan expenses to total plan assets. And then this information is compared to other plans similar in size. This information, is not from Mutual of America. This report is actually provided to us by the 401k averages book, and the data, like I said before, is based on assets, average account balance, number of participants, and asset allocation. We don't gather or provide this. The actual book has been published since 1995. And the 401k averages book is the leading source of 401k fee benchmarking data. And the benchmark report is comprised of 196 product offerings from 70 different providers. And I actually have the book with me right here. So it's like you can find it at Barnes & Noble. So anyways, if you just flip to the first page, basically, you just want to go down to the middle section here, and your plan's total dollar-weighted expense is 0.74. And this is made up of the underlying fund expense plus the administrative expense. If you look at a plan with an average total expense plan outside of Mutual of America ratio for a plan your size, it's 1%. So you're a little bit lower than the average fund expense. And then basically what we do is if you flip the next page, we translate that percent into dollars. And your plan, the cost would be $213,000. And an average plan investment fund expenses and record keeping would be approximately $289 plus. And that also includes a record keeping fee, which we do not charge you because you have over $1 million, of approximately $2,700. So I think, compared to the rest of the universe, I think we're at a good number with you.
Yeah, and it looks like it's down from last year.
The
Because last year it was 0.81%, and now it's 0.74.
yeah, because
Whereas the average
we
is...
hit a break point last year.
Yeah, because the average is just down 1 basis
Yeah, and that was,
point.
and you know what? I know we talked about that last year, and I don't think we had hit the actual break point, and because it's been 12 months. So yeah, we did. So you can see it's down. And as John was saying too, Lana's been out twice so far this year, and I mean since last year, and I know with the COVID, she's booked every time she's out here. The funds are doing really well.
Pam, one, and
Yes.
maybe Andrew, question I have. Looking at the plan assets, and we still have, it's about $2.5 million, a little under $2.5 million is stable asset money
Yes,
market.
yes.
And I know there's always some people, how do we compare to, as a group, I mean, with about almost little under 10% of our assets in that, and what kind of returns are people getting on that money right now?
Right now, it's 1%. So it is tax deferred. So 1% is equivalent to, maybe a taxable investment of 1 3/4, and that, you can't find that right now in a bank.
Yeah.
It is an interest accumulation account. There's not any type of expenses, fund expenses charged. It's, not like a money market account.
Right.
So that 1% is a true, tax deferred 1%. That's the floor. It can never go any lower than that.
Okay.
Hopefully it'll go up, but it'll never go lower.
And it's much larger than a straight money market fund,
Yeah.
which probably earns maybe 1 basis point at most.
Just as a comparison, I was talking to our treasurer today, and our town money is getting 0.35 right now, so 1% looks pretty good to me.
So, and does anybody else have any questions? The last thing I just want to briefly touch on, we talked about it a little bit last year. There are some changes coming to Mutual of America. They're all good. Basically, we are going to be changing our record-keeping and trust record-keeping platform to a different platform. The technology is going to be a lot better. We're going to Omni from Sponsor Connect. Now, with changing, with going to the Omni platform, not only do we offer more diversified changes in regards to technology, we also offer more flexibility, if you choose, in regards to possibly moving, and you don't have to, from the group annuity product to an NAV platform, which would feature all mutual funds. There's a little bit of a difference with the mutual fund, or we call it NAV platform. You will have automatic rebalancing. You'll have automatic and manual rebalancing. There will be a mobile app if you have an Apple or Android. We're also going to extend our platform of funds to 66 approximately, with a stable value fund included, and we're adding several new fund families. Again, we talked about it. You don't actually have to do anything if you don't want to. What will happen is you will go to this Omni platform, which will help you, as far as administering your plan. But it's something for you to food for thought in the future. Because you would end up, having more funds, and also you would have the ability, if you wanted to have an investment advisor or an investment fund manager, we would be able to administer the fees for that, and we could provide you with one, or also you could choose one, someone that you may, want to manage the funds and review the funds. The thing is, nothing really goes away in regards to us picking your funds. The funds that we offer you will still be consistently monitored and selected. We still have our indemnification and hold harmless agreement in place where, anything that we offer you is appropriate for a retirement fund. That's not going to go away. So, but you would have the flexibility if you wanted to add someone else on to review your funds periodically in addition to us. And again, you don't have to do anything. Everybody will go on to the new Omni platform within the next year or two. And in regards to the mutual fund platform, that's your choice. And, if you want to convert, you can. If not, you can stay the way you are.
Okay, so is there a set time period for that, or that this is, you're still looking at rolling that out sometime in the
Well,
next
we're
year?
actually rolling it out now.
Oh, okay.
Do you want to talk a little bit about, yeah.
Sure. So essentially, we rolled it out, but understand, though, that the two platforms are extremely similar. So I helped build the NAV platform. So what we did is we said, we have all these funds on the GA platform. Let's take those funds and put them on the NAV platform. So for instance, if you have DWS Capital Growth VIP, the comparable one is the same name, but it's an R6. R6 is a share class. That's the only difference. So when you look at the overlap, there's a lot of overlap between the two platforms. Shows consistency, so that if you're in a fund, most probably you're going to get the same exact fund on the NAV platform. Not every single fund, but just about most of them. Then what we did is we added some new funds. We added Catholic value funds, because we have a lot of Catholic value clients. And we also have a lot of clients asking about ESG. Now, what you already have is you already have 2 ESG funds. You have Neuberger Berman, which is a large cap ESG fund. And then you also have Calvert, which is a balanced ESG fund. On the NAV platform, all we did is say, now you can have a bond ESG, a large cap index ENG. So it just gives people greater choice. Now, greater choice doesn't really mean better. It just means more flexibility, because what was happening was some clients would have advisors, or clients would say, we don't want 49 funds. We only want 20. Or the advisor would say, I prefer to only have 20. This gives them the flexibility, but target date funds are the target date funds. It's the same in both. So some clients may move because they have a consultant or may want one. Other clients are like, why change? Because we don't need to change because everything is working and the allocation of our plan looks pretty good. So it's just everybody's a little bit different.
As we said before, I don't know if you have the numbers, but it sounds like a lot of people go into the target funds. Rebecca just mentioned she did herself. And I think one of the reasons, this is anecdotal, but I think one of the reasons people go into target funds is because they're overwhelmed with the choices. They say, how am I make any, I have no idea you guys live and breathe this every day. We live and breathe it at least once a quarter. I'm not sure, even at this table, how much we all understand, the difference between the large caps and the small caps and the growth and the value and all that. And you go to your average employee, and they're going to look at you like, deer in the headlights for most people. So my concern is that when a new employee comes in, or even an existing employee, and wants to make those changes, it's overwhelming to have that many, and so it's just a concern that I think I have that possibly, we should be looking at culling it down as opposed to expanding it out. And I don't know what your thoughts are on that and how anybody else in the committee feels, because I think that may be a problem. It becomes, overload.
Well, right now, there's, because I have the allocation here, there's a little bit in every fund that we offer. So that, I get what you're saying. And, so we could, with this NAV, this new platform, you would have the ability. Oh, sorry. You would have the ability to pare down if you want, but there is money in every fund. So that's something too we'd have to figure out in regards to what we're going to say to participants that currently have a position in those funds.
But under the option that we're currently in, we don't have the ability to narrow those funds down. We'd have to go to your other product.
Right.
Okay.
Yeah.
And so when you look at it, for instance, there are 3 large cap growth funds. There's Contra, there's T. Rowe Price, Blue Chip Growth, and there's DWS Capital Growth. Some people might say, we don't need all 3, we only need 1, right? Because if you would ask most people and most committee members, even most people in our organization, what's the difference between all 3? Honestly, I think they'd have a hard time discerning that T. Rowe is a little more aggressive than DWS. Contra has Gene Park, who's a little value-oriented. I know that, but most people don't. So maybe offer 1 instead of 3. That's kind of the thought process of clients. Now, again, there is maybe a little disruption because somebody could be in T. Rowe if you choose Contra. But when you think about it, most of the funds are the same between the GA platform and the NAV. And we did it on purpose, so that kind of minimizes a lot of the changes, I guess, or the disruption.
So Pam, if I heard you correctly, you're saying of all the funds you have now, which are how many at the moment?
Like approximately 45.
So you have 45 funds. There's there are people in each of those, our current employees, you got somebody in each one of those funds.
Yeah, there's a little, I mean, there's some of the funds, there's more, some less, but yeah,
obviously,
they're in
yeah.
a little bit of each.
Interesting.
And, actually, where's the allocation? It's right here. So there's, and I looked at this before, and I looked at, some of the smaller positions. I mean, there's a little, I mean, a lot of the small cap funds, there's a little bit in Delaware small cap, a little bit in Goldman Sachs small cap, a little bit in Victory small cap growth.
That's all right, but my
Yeah.
point was, there's not a fund or funds out there that have no action that nobody would miss. But you're thinking that this would be disruptive to somebody to pull away.
We would be able to switch them out, no problem, but I don't know how they would react to that.
Would you be able to tell on some of those small ones when the last time funds went into them, if they've just been sitting there for a long time, where the people have moved their money coming in to other funds?
I'd probably say, looking at this chart, that some of the smaller balances were since 2019, because if you think about a DC plan, there's a lot of inertia. So you look at like Delaware is a new fund in 2019, has about $1,000 in it. Victory is a new fund in 2019, has 60,000. So I think most of your smaller balances are in the funds that we offered in 2019, because people at the end of the day do not move their money too much within a DC plan.
Yeah.
But as you said, we would have the ability, if there's 4 small cap funds, if we were to decide to say, no, we only want to offer 1, well, people in the other 3, we could just move
Correct.
that into the 1, so they're still in a small cap fund, it's just they're in small cap fund A versus small cap funds B, C, and D.
Yes. Yeah. You'd have to notify them, I think, at least 30 days in advance. But yeah, we could do that. Absolutely.
So I would probably say, there's a lot of advantages to it, but it's not for everybody.
Right.
And sometimes if your plan is not broken, you might leave it there, and if people aren't complaining there's too much disruption, and you're getting education that helps with understanding what the funds are, and you get a better platform, you might want to stay, or, but it depends on every organization.
Okay. Thank you for very, very insightful, as always. Anybody have any other questions for either Pam or Andrew?
Thank you.
Yeah, I guess, last year we talked about it, and, they wanted us to talk to, everyone about it, but now we can actually pull the trigger. But again, like Andrew, if it's not broken, don't fix it. And, Lana hears the pulse going on. She's out really in the trenches with everyone, and everyone's, been really happy, and we've actually rolled over a lot of assets into the plan, to help. So I think, all the employees are pretty happy with the plan.
Yeah,
So Eric, excuse me, as chairman, is that a decision as far as bringing in all these extra funds? He's talking about another 20 funds, it sounds like. Is that something we make the decision on, or they make the decision on? Do we make the decision tonight? We let it go and think about it?
no, that would be a decision for this board to go to really, I guess it would be to change the platform. And so I think this is probably not for tonight,
okay.
but we'll get it on the agenda going forward, because I think it's not only changing the platform, but then it's also, do we just want to offer, then, do we want to change? Do we want to offer all the funds that they're offering? Do we want to come up with a model to reduce that number of funds? So I think there's a little more thought and discussion that we need to have.
Agreed. Thank you.
Well, the other thing, too, is, again, you don't have to do anything if you don't want to. You can do it anytime you want. Going forward, the veil's up, the door's open. Some of the decisions would be, too, do you want to just self-select? Do you want to have an investment advisor? Do you want to have an investment manager? But if you were to do this, everything would start with a letter of intent that we would supply you. And then basically you're looking at a 3-month period for all the changes to happen. We would be mapping people over. There would be 2 board resolutions, one to basically terminate the group annuity contract, another one to open up the NAV. If you went with a stable value fund, Invesco, there'd be an agreement. There's also a custodial agreement you'd have to sign. But we would supply everything, but you'd have to basically give a 3-month leeway for everything.
Sure, yeah, I think we realize that this
Yeah.
is not a,
Right.
decide one night and it all happens the next day. Yeah, yes.
Yeah, and I'd say
appreciate that.
it's, if you explore it, it's a conversation to have again.
Yeah.
Where we can walk, I mean, I was a former consultant, so I can sort of talk from the consulting side of it. And, what the consultant does, what they don't do, maybe what the benefits are, what the benefits are not. Do you use a consultant that we might not recommend, but suggest? Do you use your own? Do you really want to self-select? Because that adds a lot of fiduciary risk.
Right.
So I think it's a bigger conversation to kind of understand all the different pieces. Because I guess flexibility is good, but it also creates a little complexity. That might be a good quote.
Yeah. I appreciate that, and I think, as I said, from my perspective, I think this is something that, going forward for, looking at 2022, we need to give it some thought. It's not something that I think just, spur of the moment. You raised a lot of really good issues that we need to discuss and address, and perhaps need to have you back to fill in some of the blanks.
Absolutely. This is something that you really want to think about and kind of plan out. And that's why, we would have another couple of discussions and come back. Okay.
So again, thank you. Anybody have any other questions for either Pam or Andrew? If not, well, again, thank you for coming up, and good to see you live again. Hopefully this portends to future continuing live. So it's always good to see people and be able to talk to them. And Andrew, if you do have those numbers when it gets through legal, if you want to pass them along to PDF, you can send them to John, and he
I'll send it to Pam
and he gets to John, and
Okay.
John will get it out to the committee. We'd really appreciate that.
Thank you very much.
Okay, thank you.
Have a nice Thanksgiving, everybody.
You too. Thank you.
It's down here right by your, right by the
trash
can. Yeah.
So as we're moving along and getting set up, so the next on our agenda, we have Gina from Wells Fargo. And Gina, if you want to come up and get yourself all set up, and just for the board while Gina's setting up, Wells Fargo is our current custodian on the defined benefit plan side, and they're in the process of migrating, because Wells Fargo, and Gina, I'm not trying to steal your thunder, but Wells Fargo sold their business to Principal about 2 years,
Yeah, just July of 2019.
and you need to push the button. And Gina is our representative and is here to kind of give us updates on that. So Gina, at this point, I'll turn it over to you.
Okay, so as you mentioned, Principal purchased Institutional Retirement Trust Division of Wells Fargo in July of 2019. We were originally going to migrate over the Labor Day weekend, but they wanted a little more time to test all of the systems together because we're bringing the entire trust platform over there. And they have to do it over a 3-day weekend when the market's closed. And the next when they didn't do it on Labor Day, the next 3-day weekend obviously would have been year end, and we promised clients we would not do that on a year end. Yeah, that would be a happy new year. So the next available 3-day weekend where the markets are closed would be President's Day. And I know I've had some clients ask me about Martin Luther King Day, but the bond markets are open. So we couldn't do that weekend. So it's going to be February 22nd. John, I don't know if you got a communication yet or if Audrey got it. I'm not sure who would be getting it. But it should come out today or tomorrow.
I think I got an
You got
email
today. Okay, so it did go to you. So in that email, it's the pre-migration checklist and also the pre-migration operational notification. So I would urge that you click on the link in there, and it'll take you to, it's a really nice page on the principal site. And the landing page is a countdown page, so it's almost like counting down to the new year, but it's counting down to the migration date. And then there's some information. One of the things that we're going to invite you to is, I have to get the date because I always forget the date. There's going to be a migration webinar on January 13th. So I would definitely tune into it. I think it might be available in a recording, and it'll probably be on the principal website. Now, the reason why is you're going to start to get emails between January and February where you're going to have to authenticate yourself on the principal website and then assign people within the town who need access to certain functions. So I want to make sure you don't miss that so that when you go live, you'll be able to go right in.
Okay, so that's the people that are on there now.
Yeah, so it'd be Audrey and, right, yeah. Right, but you're probably going to be the person that's going to have to do it because they're going to give function to one person. For the payment system, no longer going to need a VPN. There'll be a secure website, so that VPN goes away, which is also really good. But there's going to be an authentication email in mid-January. So that's why I said in mid-January, I would definitely keep my eye on that. And then if you bookmark that page, just periodically pop in there to see if anything comes up, because they'll put it right at the front, any changes. In the meantime, I will also be reaching out. And you did get I see you.
Yeah, I called it up on my phone.
Okay. All right, good. So that's really where we're at. I'm confident everything should run smoothly. Texas, the people that you deal with in Texas today are the same people you're going to deal with on a go-forward basis. That office is staying right where it is. The folks there, I mean, unless they leave, the same folks are there. Your wire instructions will change. And ironically, principal uses Wells Fargo, so the only thing that's going to change is an ABA number. So it's pretty much still going to be Wells Fargo, and we'll give you that. Your account number is not going to change. It's going to migrate over the same. And you'll just be going in through that principal portal where you go into Wells Fargo CEO today. So I'm glad you got the email today. I knew it was coming out, so I'm trying to get to everybody. Did you have any questions or?
No, I didn't really look at it,
Nobody
to be
does.
honest. but-
Just remember, I would definitely make sure I get on that webinar. Have you been on any of the other pre-webinars? I know we had a couple of trust and custody.
You really want me to answer? in
No,
public?
don't answer. I would say from this point forward, though, I would pay attention.
Gina, one question I have, and it won't relate to this year, it'll relate to next year.
Sure.
But with that change for participants that are receiving benefits,
Okay. I'll adjust
will they
that.
end up receiving 2 1099s, or will they be receiving 1 1099?
They figured it out. I don't know how.
Okay.
I'm going to guess that they're probably going to use that principal tax number on, beginning January. I'm not sure, but that was one question, and they did figure it out, so it'll be 1.
Okay, that's beneficial, because I was going to say, if
I know.
that was something that was going to come up, I was going to advise John, we got to get some education out to people so that, because they start all of a sudden get 2 forms, people will.
Yeah, that'll happen in 2023, so yeah.
We
that would've
have a
helped
lot of time, but.
Yeah.
But yes.
They probably won't see any change in
No.
getting their funds every month either, if it's coming out of Wells Fargo Bank, right?
Well, some people still get checks, believe it or not. I don't know how many of yours do. I mean, we've really, really attacked it for most of our clients to try. I mean, you can't get your Social Security goes through a debit card now. So I would think most people, but you still have those holdouts.
We probably still do, too.
Listen, I have a town with somebody on the board who still gets a check, so,
We still have 20 people on the payroll that get checks.
right. It's just one of those things. It's hard to break. People want that. And I think it's crazy because in bad weather, it doesn't show up, then they're scrambling. It's just easier to go into the checking account. But we will be sending communications out to the pensioners only because we're concerned. And then the phone number is going to change too if they have questions. So they're going to have to dial another number for questions. The good news is there's going to be new bells and whistles. I'm not sure what's going to be available on day one just yet. That'll start to come out in the migration communications. But I do believe that retirees will have more access to change their addresses and banking information. And I believe they will have online access at some point. It's not going to be day one, but it will be shortly thereafter. And that's what we've had a lot of our clients ask us, can retirees actually go in and see their information online?
And Gina, I also assume that means that retirees will not have to provide new forms for withholding and everything will just carry over as it is?
Yes. Everything's going to be moved exactly the way it is. So they're going to start, their first two checks, the January, February's will be the Wells Fargo normal, if they have any questions. And then the March, it'll be under the principal under the principal name, that platform.
This is my accountant tax.
I get that, believe me.
I know when I get this from clients, so I'm just trying to
anticipate
ask those questions that I know I see from time to time.
Yeah, that's probably why we want to keep Audrey in the loop and everything too, because she'll get phone calls guaranteed.
She gets them all the time now.
Yeah, she gets them. I keep getting just as for chuckles, I keep getting a phone call from some poor elderly woman who calls me, tells me her name, and then tells me I'm not calling her back, but she never leaves me a phone number. I don't know who she's with. She doesn't tell me where her pension comes from, but it's
not the town of Orange, and you're not sure.
I have no idea where she's from.
People call, they assume that everybody has caller ID and you'll just get a number.
Right.
I get those too.
Yeah.
But will you have, to the point of Audrey getting calls, is there going to be any information to be provided to John and Audrey for just a communication to go out from the town to the retirees to give them,
all of that's going to
information for a notification?
Yeah, retiree notification is built into that migration plan. And that's what I'm saying. As we move along, I'll make sure I reach out. If I see something come up, I'll harass you. I'll call.
That's fine.
I just call. I become a nag just to make sure. I might even just leave a voicemail message saying, John, something important came out. I hope you saw the email. Just.
Just leave your number.
Yeah. Well, he knows how to reach me. So, any other questions on that?
Anybody have any other? I assume you're migrating to principal too, Gina?
I am migrating to principal.
Okay.
Yeah, I was going to have my home office with principal, only I started 18 months earlier, almost 2 years earlier, because I've been working from home. So, yes, we're all moving over as well.
Okay.
So continuity is there.
Well,
that was actually one of the things that principal wanted to make sure, was that all the employees were going to come over, because it was important to them.
Yes. Makes for a much smoother transition and
Right.
for all the customers.
Right. So that is going to happen.
Okay.
Gina, did you catch the date for next year for you at this time?
To come in? No.
Yeah. Okay. When will I give it to you?
If you give me that date, because my calendar's not going to move
It'll
with me.
be November 17th.
Okay. I'll put it in on my phone, because then at least
That
I
way you
know.
have it a year in advance.
I'm getting a lot of I'm accepting a lot of meetings, and I'm like, oh, my calendar's not migrating. That's going to be fun. So, yeah.
So, well, thank you, Gina, for the update.
No
and,
worries.
Look forward to getting through this migration process.
Yep, and I'm local, so I can come out if you have any questions.
I don't think it's going to be a problem, long as you get the money to the
Right.
retirees,
And
we're
you'll be
good.
getting that's what's going to be in that migration, that pre-migration guide, and then as you move along, that's why I said keep your eye on that and bookmark it, because all of that information, everything's going to pop up and populate on that. And what Principal's platform is, it's pretty much a self-service to the client. Everything you want, you literally go out to your account, and everything's out there. So your instruction, you can find everything there. It's pretty amazing. It's literally like a coin-op machine. Just go and press what you need. Okay?
Okay.
Because I've been out there. It's definitely a great system. Okay?
Oh, yep.
All righty.
Thank you for the update.
Thank
Gina.
you.
And we look forward to getting through this transition and keep our fingers crossed that it all goes smoothly.
No, I'm not taking any vacation during that time, so I got it all in.
Great.
Thank you. Everybody have a nice Thanksgiving.
You too.
Thank you,
Thank you, Gina.
Hi, Gina. I'll defer to the chair.
So-
I think you need to.
No. Okay.
No, I don't think so. No,
No, I don't.
Yep.
But you guys know how to reach me.
So next on our agenda, moving along, let's keep everybody in place. We have Chris and Scott from Fiducian, our defined benefit plan advisors. So while they're getting set up and handing some things out, yes, please. Chris is recurring, and welcome, Scott.
Thank you very much.
And at this point, I'll turn it over to you. As we said, just remember, if you're going to speak, just push the button and keep the microphone in front of you so that it gets picked up. At this point, I'll turn it over to you.
Super. Good evening, folks. Hello, Mitch again. Mitch and I saw each other yesterday morning and down on the shore, so good to see folks again in person for sure. We've got kind of the full details on the pension plan update. Obviously, I think in the interest of time, I'll do the quick version of that. I think we're in pretty good working order. From a performance perspective, an allocation perspective, the managers are all doing just fine, so we don't have particular issues on that front. We'll get you through that material quickly. You did charge us and ask us at the last meeting for some independent perspective on Mutual of America and what we see there. My colleague Scott Bolton is one of our senior consultants on the defined contribution side of the ledger. So he deals every day and regularly with all the record keepers and across the 25 some odd muni DC clients we have in the state of Connecticut. So he'll offer up some of that perspective to you momentarily. So with that, I'll use the booklets. Are you all set, Barbara, with that?
I've got
Oh,
it.
you got it on? Okay. So if you turn ahead to page 5 behind the first tab, just really 2 or 3 quick points on the governance front. This is the quarter, you'll remember, where we just aggregate some of your high-level actuarial data from Milliman, and we draw some comparisons to some of the state averages, just to give you a little bit of color and perspective there. So on pages 6 and 7, you'll see the latest valuation studies that we had ready access to, and you'll see funded statuses there for the 2 plans, a return assumption as well. Statewide, average funded ratios are about 72% today. That details a page or 2 later in the booklet. And the typical, it's not listed in the booklet, but the typical return assumption, you're using 6%. You've always been very disciplined and conservative with that, as you know. Statewide averages are still up around 6.7%. So in our minds, you've got reasonably comparable funded status levels across the plans, but are doing it with a much more ambitious, right, and lower discount rate. Were you to have a discount rate more akin to state averages, your funded ratios would be, even more competitive. So I think you're in good working order from an actuarial perspective. No particular issues there. On page 8, you'll see another Milliman survey. It's a national survey of large plans. These are the CalPERS of the world, the state of Connecticut plan, the big national plans. And they did a little bit of survey work and came up with some details around returns. This is indicated on the top of the graphic here for the fiscal year period ending in June of this year. You see there the representative performance was just shy of 20% for those big 100 plans nationwide. It's not in the booklet again, but if you remember from your June report, over that same period, the town plan was up north of 27%. So it had kind of readily outpaced what we saw with some of those large systems. So those are not anything we need to act on or respond to other than just information for the committee's edification and to give you a little bit of comp. And I know every summer we obviously have the Milliman folks in, and they do a lot more detail than this. Anything on governance that we missed or needs more? No, people are good? Great.
No, but it's good to have a little sanity check to see
Yep.
where we are relative to everybody else.
Yeah, I think really most noteworthy, Mitch, as we've talked about, Eric, as we've talked a million times, you've always been very thoughtful with the discount rate, right? And you run in front of those trends. And I think ultimately that's a conservative measure, but an appropriate one, and it puts you in good standing.
Chris, I'm just noticing, I guess, I don't recall our fund ratio being as low as it was a year ago, but I guess it is what it is. And it's interesting, our fund ratio actually went up with our discount rate going down. I didn't think that was happening, so I don't remember those numbers being what they are, but I'll double check, or maybe you want to double check.
Yeah, I'll check them again with our analysts. You know, the one thing I did note, and I think I mentioned this, Eric picked this up, and it's not in the booklet. The data on page 7, it is 2021 and 2020, like the schedule above.
Okay.
You see, just the headings there are
Yep.
off, but it's the right data.
Okay,
We can check that.
thank you.
Mitch, I think as we've been dropping the rates and everything, so I think we did get to, especially on the police plan, that funded ratio did get dropped way down.
Okay.
Because I think it was a combination of dropping the rate and with contracts, et cetera, so,
Okay.
yeah.
Thank you.
All right, let's turn behind tab 2 to page 10. And we're not, my intention is to go quickly here unless you folks stop me and redirect. But just quickly, I think we've cataloged on this page in the upper left-hand corner just some of the overarching themes that investors are grappling with right now. Most prominently among those themes is this changing Fed message around stimulus. And you've been reading, right, that they're beginning to remove that stimulus from the system. They're starting with pulling back on the amount of Treasury and mortgage-backed securities they buy every month. And that effort will be underway probably through the middle of next year. And then it's all likelihood they're going to begin to raise short-term interest rates toward the end of 2022 and into 2023. You see that graphic in the upper right-hand corner of the page. That is projections from all the Fed governors who vote on interest rate policy. And the takeaway from the graphic there, just kind of you see the variety of different expectations across the grid. Really what the markets are saying and what the Fed is messaging as well is this is likely, it's happening and happening, pretty rapidly and in a pretty meaningful manner as well. So some of those expectations are starting to be drawn in a little bit closer than they were, say, 6 months ago. So that's just something to be mindful of. The Fed's been extraordinarily transparent this whole time, right? They've been messaging and messaging and messaging, and it seems like markets, it's instilled a lot of confidence in investors, and there's a hopeful expectation, right, that these transitions to less stimulus, still accommodative, but less stimulus, can maybe be implemented with not too much friction in the market. So we'll see how that all plays out. We've had a good deal of policy gridlock in Washington, right? We did have the infrastructure bill pass about a week ago, and there's more talks, as you know, in legislation being contemplated. So that's something that investors have been talking and thinking about. And then finally, and unfortunately, the Delta variant continues to kind of wreak some havoc and something that continues to need to be managed. On the positive side of the ledger, consumers financially are as strong as they've ever been. You see there the graphic in the lower left-hand corner of the page. We use the net worth plots, household net worths, and then household debt service ratios. And since the advent of the pandemic, those measures have improved pretty meaningfully. And there is a lot of pent-up demand and a lot of monies we think that will ultimately flow in the system when we get through some of these headline challenges. And then the final thing, I think Andrew made reference to this as well in the lower right-hand corner. We have had this evolving sponsorship in the markets at what's worked best. Pandemic starts, large cap growth does great. We transition into value and small cap and international to an extent in the fall of 2020 into this spring. And this third quarter, we actually went back to those large cap names and the growth names doing the best among risk assets anyways. That's the landscape there. On page 11, again, I'm not going to linger here, but just because everyone's been reading about it and it's probably the hot topic, inflation is very high. You see that in the lower left-hand corner of the page. Alongside those big bumps in inflation that have been a byproduct, as you know, of the run-up and ramp-up in demand that was so extraordinary out of the lows of the essentially manufactured recession we had when the economy was shut down. That ramped-up demand, it kind of coalesces with the fact that there's not enough supply, right? And you've read these stories about supply chain disruptions and cargo ships out in Long Beach and they're trying to unload all those. That's going to take some time to work through the system. We do think ultimately the Fed has mentioned this, that this is a transitory thing. We're going to have to, deal with this inflation for a short period of time. We do think ultimately that these, markets do recalibrate, the economy recalibrates, and some of these pressures begin to ease. And while we'll have a measure of higher inflation, it shouldn't take us off the rails in terms of that next wave of economic activity that we're expecting.
But Chris, on that, and maybe this is a more theoretical economic question than anything else. If there's a continued disconnect between interest rates that really the Fed is creating and what inflation is, which basically you end up with that we have negative interest rates in a lot of ways. I mean, is that sustainable going out, or is there an inevitable reckoning that the market's going to say, everybody's going to wake up one day and say, no, inflation is running 5% and interest rates are 0.5%, and that gap just doesn't make sense anymore.
And so those differentials have to reconcile over time for sure. Right. Certainly on the front end of the curve, the Fed is going, to begin to raise rates. So that's a measure of relief, I suppose, if you will, at least in that comparative. And we do think probably over time, if the economy kind of fleshes out and continues to grow as we expect, that just innately interest rates will start to rise too. You've seen that this year, right? The 10-year Treasury's gone from 90 basis points or 0.9% up to 1.6%. And that trend probably kind of continues to creep in and better align with the inflation trends that we're seeing. Right? The market right now thinks over the course of the next 10 years, if you look at the metrics, that inflation is going to be about 2.7% a year. That's what the market is saying today. Right, so that's not what we're seeing in the recent prints, right, where we're up at 4 and 5%, but it is higher than it was at the beginning of the pandemic when we were down. It was stubbornly low. You'll remember on the other side of all this concern about higher inflation, the Fed was struggling to try to increase inflation, right? It was too low. And they're trying to strike that balance about, where it should reside in terms of a growing economy, full production, and all those other type of things. And they say that a 2.5% to 3% inflation level is palatable and doesn't take, the economy off the rails. So I think that's what ultimately they're targeting. And you see with that, I just mentioned, that's kind of what markets are expecting as well. Is that
Yeah.
helpful there?
That helps, and it will lead into a question that I have as a follow-up, but go ahead.
Do you want to do the follow-up now? Or do you want
No, you'll get there, and
Okay, fair enough. I'm not going to spend any time on 12. I think Andrew hit on this a little bit already. I'm sorry it's late. It's been a tough year for fixed income, a better year for equities globally, except for emerging markets and things like real estate and the like. You see to the far right have performed pretty well also. So that is the backdrop, big picture. If no one objects, I'm going to jump behind tab 3 and just spend a couple of minutes on the portfolio. So you see there we've got about a little north of $30 million of invested assets at the end of September. And an allocation, current allocations that dovetail pretty closely to target levels you see in the fourth column over. So I think from that allocation perspective, we're in good working order. We did work with Eric in mid-September, and we did some raising. We raised, I think, if I remember correctly, about $1 million. We took, and that was to replenish the liquidity bucket for pension payments and the like. That was sourced from domestic and international equity and extend to real estate, which at a point in time when we did it, we're a little bit overweight. So we're just always mindful, as you know, of keeping disciplined with where we stand versus those targets. So I think the allocations are in good working order. The one manager to highlight for the committee, it does not compel any action tonight, but we did elevate MetWest Total Return. You see the first fixed income manager there in your schedule to discuss this quarter. There was a retirement of one of the portfolio managers on that team scheduled for the end of this year. And he was a meaningful contributor, but not the only one. Our research team does ultimately think they work through that transition, and the remaining portfolio managers are very well schooled in there's the MetWest style of investing. So we think that transition, again, works out just fine, but a slightly elevated status just to acknowledge the retirement. Otherwise, the lineup is in very good working order. And then on 19 is some performance data. A touch behind in the quarter. I think that's the first time we've had that in quite some time. But you see we have the plan down about 90 basis points. I'm in the middle of the page in Q3. A little bit behind the benchmark, but again, right, more of greater importance to us are the longer dated numbers. And year to date, 1 year, 3 year, really on out through time. The managers, right, have pretty consistently generated incremental returns north of that benchmark. So we're in pretty good working order. It's kind of interesting, right? If you go to the far right of that exhibit, you're currently targeting a 6% return, and you go back to 2007 and 6.2%, pretty darn close. Kind of an interesting comparison. So I want to be sensitive to time. I know it's been a long night. I know we want to spend a little bit of time with Scott on the DC situation. What did I miss? What needs more context? What questions may you have?
Well, so my follow-up question to just on the interest rates and inflation, and since I sat at this committee probably for the last 6 years or 7 years and always talked about why are we putting things towards commodities or inflation, because there isn't any. So now, of course, I'm going to ask the opposite question, which is, just because of what you indicated with the potential surprise is inflation stays higher and there's a kind of a reset from an interest rate, does it make any sense for us to not completely shift our asset allocation, which I think is right, but just within our fixed income space, to allocate slightly more assets to the TIPS account to give us kind of that cushion should there be a surge in interest rates? Or because we're using some active managers on the fixed income side, they're going to take that into account?
I think it's an answer with a two-part answer. You did a measure of that protection today. You've got some tips already, as Eric, as you mentioned, right? It's not a huge amount, but you do have some of that exposure already. You may have unrelated, but remember you have measures of inflation protection, both from equities, which tend to do fairly well when inflation's a bit higher, and that's the bulk of the portfolio. And then moreover, REITs have had a pretty good run here as well in a somewhat elevated inflation environment. BlackRock, one of your dedicated managers in fixed income, the most kind of eclectic of your four, certainly plays in the tips arena, the floating rate a bond arena, other areas that do well when inflation's elevating and rates may be ticking up. Next quarter is the season when we're kind of refreshing our capital market expectations. We're going to run your portfolio through that optimizer, so we'll have more explicit answers for you. And alongside the bigger allocation conversation is just the complexion of the portfolio and its construction. And I think that'll be a perfect segue in, if it suits the chair, to have that more detailed conversation around the amount of tips, more tips, other type of things that may do well if inflation runs a little bit higher and longer. That makes sense to folks?
That makes perfect sense, and you answered my question that you're on top of it, so that's a good thing.
Oh, good. Anything else from the other members? All right, I will cede the floor, Mr. Chairman, back to you. And again, as mentioned, just as an introduction, Scott focuses exclusively on defined contribution plans and is working, alongside all the record keepers and knows them intimately and certainly better than I do. We have some fairly recent experience with Mutual of America. We certainly want to be respectful of them and the work they've done for you through the years, but I think you want us as well to give you some honest assessment and what else we see out there. So with that, I'll turn it over to Scott. And
just as a matter of a quick introduction, and to remind everybody on the board, we had discussed this the last meeting, and really, I think in connection with what Pam and Andrew had talked about, just from the Mutual America standpoint, that they have a change in platform. We now have $30 million of assets in that plan. We've been using Mutual America since we started the plan, and that's in excess of 20 years, more than 20 years ago, closer to probably 25 years ago. And not that we've had a bad relationship, but like everything else, where we were 25 years ago, where we are today, where the market is, I think we felt that to get some outside insight and some information would be helpful to this committee. So, Scott, I'll turn it over to you.
Perfect. So again, as Chris mentioned, I focus exclusively on defined contribution plans. Been with the firm a little over 7 years now, and prior to that, I worked at a different record keeper, T. Rowe Price, for a number of years before joining Fiducian Investment Advisors and so forth until we get to the Fiducian name here. So I focus, as Chris said, exclusively on defined contribution. That spans from corporate America, nonprofits, higher ed, and I do lead our space, municipal practice on defined contribution with the firm as well. So quite a bit of experience and specialized experience in this space. As Chris mentioned, I had another client come on board that did have Mutual America back in 2019, and we did a full assessment of their platform, of their funds and everything, and came to a recommendation to them at that point was to test the market and look at other record keepers out there outside of Mutual America. I'm happy to kind of give my high level overview and thoughts of kind of where they might shine, where we think others might have advanced faster than them in terms of technology, in terms of platform and the like. I'm not sure if there were specific questions or areas of concern that the committee had that they wanted to address, and I can answer those from the get-go.
I wonder if we could start, Scott, maybe, and the chairman can redirect me, maybe just to set the record keeper aside, just what do we think about in terms of number of options, type of options, and just how you build a plan that best attracts participants in and keeps them engaged, and kind of maybe some of the attributes that the record keepers we favor have
to help reach that maybe end goal.
Does that work for you, Eric?
That's fine, and also, and just so you know, I had a conversation with Chris and Scott a few weeks ago, and one of the things, so that everybody's aware, they indicate to me, which was surprising to me, is that I guess based upon Mutual America and their average client, our asset size puts us probably as one of their larger clients of the whole company, not just within the state or anything, but overall. So we're kind of on the one end of what their typical client in terms of who they service is at this point.
Yep, that's correct. So as Chris mentioned, and I'll give you a more landscape of what we typically see, across the industry, is almost every other record keeper. We do due diligence on over 40 record keepers annually. We have exposure with clients to about 22 of those 40. So we have a great understanding of what everyone else is doing. Pretty much all of those have just an NAV platform that Mutual America is now finally rolling out. And they have what I would call an open architecture NAV platform. And what I mean by that is instead of having a preset screen menu of 36 funds or 45 funds, or is it 70 funds, they would have 15,000 funds available to choose from. And then sponsors like yourself work with an advisor to select what the most appropriate funds would be for a plan. That gives you a couple different benefits, we think. One is you don't have this lean towards proprietary investment options. On the Mutual America platform, the only target date options that they have are Mutual America target date funds. You don't have the option of going to a Vanguard or a Fidelity or a T. Rowe Price or a BlackRock, so to speak. Same thing with the index options. Same thing with the stable value or fixed funds. So you're kind of handicapped in terms of what options you can choose and if they actually are best in class or not. So that's kind of where the industry has gone. They're finally rolling out a mobile app with a new platform. Every other record keeper that we work with have had those for 5-10 years now, and kind of technology-wise have leapfrogged where we see Mutual America at this time. There's also, I know they do some of their benchmarking and reporting that they showed you. I think the average record keeper or plan that we work with, specifically municipalities, we tend to, when we look at fund menus, we look at the target date funds counting as one investment option rather than breaking out all 10, just because in theory, if you're in a target date fund, it should be the 20, 30 versus you're using all 10 of them. But the average municipal client that we work with would have somewhere in the ballpark of about 15 investment options with the target dates as one. So if you broke that out, it might be 25 total versus the 46 that you see here. And again, as Andrew was mentioning, kind of what we see as the best practice is a less is more mentality. So rather than having 3 different large cap growth funds where you have to go through and decide which one makes the most sense as an employee, as a sponsor and a fiduciary for the plan, selecting the one large cap growth fund that is the best option for the plan. Same thing with the value side, and making it more of an easy to understand, easy to digest fund menu for someone coming into the plan versus you get an enrollment packet. There's 47 different options, and which one's the right for me. A little bit harder for them to understand and go forward with that nature.
And Scott, how about just from a overall cost standpoint? I mean, they indicated, I guess, all in, right now we're at about 74 basis points, which, as I understand from them, is including the annuity separate account fee, I think.
Correct. Yes, so that is including the annuity.
I mean, given the size of our plan, number of participants, is that competitive? They say it's very competitive. Is it, or are we off on that too? Or?
I wouldn't say it's unreasonable. I would not say it's overly competitive as they put it out. We've looked at the 401k averages book. We think it's very basic. I mean, they have a total of, what they said, 195 total benchmarks in there. So total plan benchmarks. In your category, there's 56 total benchmarks. That's not a whole lot. There's also, the PSCA, Plan Sponsor Council of America. They put out their benchmarking report every year. We also subscribe to that. There's thousands of plans in there, so you get a much more robust benchmarking. And we do our own internal benchmarking with the plans that we have, that we advise on. I did a quick look at ours. Based off of your size range, and that puts you in the $25 to $50 million bucket for us, which is, you're on the lower end of that range. The average for us for all-in fee is 48 basis points versus the 74 basis points for your plan. In terms of what they're receiving to record keep the plan, I'm not a fan of them saying personally that they're doing zero record keeping fee and they're just doing this out of the goodness of their heart. They're obviously making money, and that's through that separate account fee. Based off of your assets now that you're over the $25 million mark, the separate account fee is at 35 basis points. That doesn't get assessed to the stable value money market or fixed income assets. If you back out and say what's the total planned fee for record keeping, that puts you at right about a ballpark about 31.5 basis points. Of that, 74 basis points goes towards record keeping services. I would say that also benchmarks high specifically against municipalities locally as well. We've done a recent RFP for several municipalities in this size range, and have gotten some down to be a handful of basis points, less than 10 basis points for a record keeping fee.
How about from the standpoint of number of participants and average balance? I mean, are we comparable to what you see in other plans? Are we
Yep. No, you're
on that,
you're comparable. You have a healthy plan. You have at least of this report, $29 million and about 200 participants. That's a very healthy average account balance for a municipal plan.
So I guess at this point, from your standpoint, what would be a recommendation for us to consider? I mean, where do you think we should be? What should we be looking at this point?
Our recommendation, I think, would be to test the market. You've started the plan with Mutual America. I don't believe you've ever bid them out against the open marketplace since then. And you've obviously grown from zero to now about $30 million in the plan. So that's fantastic overall growth of the plan, and you're in a completely different ballpark, if you will, in terms of where you would be for a new record keeper going forward. You're also going to have better different administrative options, and I think more fiduciary control in terms of fund menu design, selecting best-in-class options. They mentioned that you have more fiduciary liability, if you will. Now you're selecting funds, but they don't take a fiduciary stance on selecting these funds for you. So right now they're saying we don't take a fiduciary stance. If you have trouble with the funds, that's on you, but you can't make any changes to them. So our recommendation would be to test the market. You can do an RFP, obviously include them to respond to the RFP as well. But there's a lot of other record keepers, locally here that target municipalities. We think do a great job with it. And at the end of the day, you can see what's out there, and if it's more beneficial for the plan, transfer to their platform versus looking or transfer to the Mutual America platform.
I guess at this point, thank you, Scott.
I just have.
I'll open up to
Are
questions.
these other plans using an investment advisor to help them select the more compressed number of funds that are being offered?
But all of ours would be a yes. And I would say most plans who have gone down the road of actually looking at their plans and doing due diligence have gone through and hired an advisor for that. For most of the municipalities that we work with, our fees are assessed to the plan. So we would negotiate fee reductions, oversee the funds in the plan. Our fees are in the plan, typically a flat dollar amount fee, not based off of assets. And I think every time that we've gone through this process, we're able to find more savings, even with our fee added in there. Participants save a lot after that.
John, go ahead.
One of my concerns ever since I've been here is that we really don't have anybody looking at the funds like Chris does and the defined benefit plan. Where I came from in the private sector, we did engage a stockbroker to do that, and we did meet more than every quarter sometimes, and we pulled out of mutual funds into other funds because of manager changes or the way the funds performed and all. And I think that's one of our weaknesses here, and I think you spoke to that.
Well, theoretically, that Mutual America is performing that service for us, and perhaps, again, if when we started and we didn't have enough assets, that was appropriate, and I think they're still doing it. I mean, they say they are, but yeah, you're right. My experience has always been with plans that you got a much broader option, and then there's somebody coming in and you can move in and out of funds, during the year or as things change, kind of similar to what we get on this side, as managers are being monitored and a fund needs to be dropped and substituted, that happens timely.
Scott, one other question. Who are some of the other people or businesses that do this for government? Somebody that we'd recognize?
Yeah, so locally, it just really depends state by state, as every state's quite different in terms of, especially in the municipal marketplace. In Connecticut, I'd say the largest players that we see, one is Mission Square, used to be known as ICMA RC.
We have them for our 457 plan here.
Yep. Yes, we work with them quite a bit. They're, I think, one of the largest players. They have just over 100 municipalities that they work with on defined contribution plans in the state of Connecticut. I'd say Voya has been aggressively going after municipal plans. Empower, if that name's familiar to you,
They bought Mass Mutual and a couple of others.
And
so, yeah.
a whole bunch of others. Yeah, they were Great West, J.P. Morgan, Putnam came together to start
Putnam,
Empower.
yeah.
Then they bought Mass Mutual, who had bought the Hartford. Both of those were large municipal players. So Empower's now a large player here. And so the last one is probably a few more. Lincoln's another very large one that we see in this space as well.
Okay, thank you.
I know Principal is on. We have it on the DB side. Are they big on the municipal 401k or the DC side? Because I know they're doing a lot on private 401k, but
They have some municipal plans, and the town of Westport uses them. They were Wells Fargo, and then they acquired the Wells Fargo book of business. But prior to acquiring Wells Fargo book of business, we did not see them responding to many RFPs for municipal plans.
And you don't see Scott, just interested, the Fidelities, the Vanguards, the T-Rows tend to, if they're in the municipal space, are way up market.
Yeah, I mean, Vanguard and T. Rowe Price wouldn't touch any municipal plan. Fidelity would go after maybe a state plan, or $500 million in assets and up, but they don't play it in this space as well. A Nationwide would be another one kind of in this space as well.
so any other questions for Scott? And
Just
open
where does
discussion.
that leave us?
Well, that gets to discussion.
I mean, wish we'd go out and look at it, going through an RFP?
My feeling is that we're kind of at a point where we need to look at Mutual of America to do something anyways, to go from where they are to this NAV platform. And if we're going to do that, then I don't think there's any harm in broadening that scope and looking at other options, so at least we know on an informed basis what we're getting and what's out there. And is this truly the best option for us, or is there something that offers more options to all the participants?
And I think also just in fulfillment or fiduciary duty, do we want fewer funds with a more rigorous review of the managers, such as we get with the pension plan. That would be my concern.
Yeah, I think even if we get to the point of making a decision, sticking with Mutual America and going to their net asset value, I can't get a comfort level of saying that we're going to offer 66 different mutual fund options, which means we still have to go to the, either utilizing Chris's group or somebody else to assist us, because I don't see that that we're qualified to kind of start whittling that down. So we're getting to that point anyways, and I would agree, Barbara, I think from a fiduciary standpoint, that's kind of our role to kind of look at this and say, is what we're getting for the town, what we're getting for participants, we feel is the most appropriate and getting the best benefits in total for everybody.
The thing we got to remember now too, this 401k plan or 401a plan has as much funds in it as our defined benefit plan, and we have to be careful of what we're doing on it now, especially.
Oh, yeah, and to be clear, I'm not saying automatically this is gonna make it, that we guarantee to change anything. I just think that, I think, Scott, you do raise a lot of issues and a lot of information that we should, properly evaluate. And we are at a point where on the plan that, we have, if we had said we had looked at this, 2 years ago and done this, and to redo it, I'd say, no, that's probably not worth it. But this is something that we've never done. And I think we're, at a point, and especially if, Scott and your group can assist us in that, not looking to all of a sudden put this on John and say, oh, go out and do an RFP, go out and do an RFP process. I remember what that was when we did that on the DB side, and that was a tremendous amount of work, internally to go through that, both, for investment record keepers, custodians, all the way down the line. So not looking to add to a burden of an overly, taxed, thinly staffed finance department as it is, but if that's something that you could help with, that would be appreciated.
Yeah, we can definitely help with that. Like I said, we do, as a firm total across a book of business, we did 50 RFPs last year. So we're very well versed in running these RFPs for you. I can definitely work with you. I'm not sure with purchasing, if there's any procedures here that we have to follow, whether it's a public bid, or we've also have some towns where we can send this private out to a select few.
Yeah, it would be professional services, but, on the other hand, I don't see why, professional services from a decision standpoint, but you still want to go out, to I would think, to the field and see what you get.
Yep. Yeah, we've run plenty of those before, so we're happy to run that for you. And then the only other question I would have for the committee, hopefully throw a wrinkle in, is just, you mentioned you have a 457 plan as well. Quite a few of our municipalities will bring that into the scope of this discussion as well, for two reasons. One, there are other assets there. There are, similar to the 401a, there's, investments there that, can be monitored and whittled down. And then two is economies of scale. If you have two plans to bid out with more assets, you're going to get better pricing than one. So,
John, how much do you know how much we have in assets in the 457?
I don't know, but we do have, the 457 is basically only the elected officials and a couple other people, including myself. The other 457 is with, now that I'm thinking about it, is with Mutual for the town employees that aren't elected, or few individuals, the union people that want to participate. That's with Mutual, so I think we'd definitely want to do that. And if we're going to do that, we might as well do the 457 plan that's for the elected officials, I think. Do it all at once.
Does this committee have any jurisdiction over the 457s?
No, that's pretty much run out of my office. And it probably hasn't been changed.
I mean, as much as we have jurisdiction over 401, right?
No, maybe, yeah.
I mean,
We never go over it or anything, but
the pension committee, but we've taken on the 401. I don't see why we don't, look at the 457 as well at the same time.
I mean, but-
457, I think, was started during your,
Yeah.
right?
Might have been just before me, but yeah, around that same time.
I mean, my feeling would be that, I think Scott's right. If we're going to get a better bang for our buck for the participants as a result of that, then yes, my leaning would be to include that as part of the process.
And I'll just say, we'll probably get a better bang for our buck too, I could say from knowledge. The 457 that I'm in, we have no advisors. I take that statement to my outside broker and ask him to look at it and pick the funds, so.
Absolutely.
Yeah.
So, okay, I guess, are there any other questions of Scott or other discussion? And if not, then is there a motion that would be generated of how we want to proceed?
I think you probably need to get some kind of quote from them on what it'll cost, and maybe then we make the motion. I'm not sure if the motion should come before that.
Well, then how about a motion as to that we could get a proposal from Fiducian as to how we would proceed with
To do RFP.
with an RFP.
So moved. Look at the barber there.
Second.
Is there a second? Did you understand that? We're good.
Say it one more time.
The motion is that we request a proposal from Fiducian as to to proceed with an RFP and what Fiducian will provide and what the costs would be.
And then Eric, well, first of all, would that come to our next meeting or before our next meeting? Here's what I'm playing out with this. If Scott brings it back to us at our next meeting for a decision, the next question is, I'll turn to John, where does that money come from? Because almost all of our workings with consultants come out of the funds. We wouldn't take this. Where's this money going to come out of?
I'd either have to look for it someplace or go back to the Board of Finance and ask for appropriation. I mean, there could be spots on the current budget where I could move the money to pay for it, depending on
So my
cost.
point, the reason I'm asking the question is then, so Scott comes back at our next meeting, which is what, February?
Yeah, or we could, I mean, if we choose, and I guess, Scott, as to what the time is to get that back, but we don't necessarily have to wait until February. We could always do a special meeting to discuss this so that so that we're not, that this isn't all of a sudden going to be dragged out until
For another
next
year,
summer.
yeah. So, so that makes sense, to have him come up with something, us probably put together a special meeting to discuss that, but then it's going to have to get approved by, I guess, the Board of Selectmen and possibly the Board of Finance.
So, but we could also look at the cost and depending upon what that is, I mean, it could potentially get charged to the funds as well.
Let me ask you guys, what's the typical cost without holding you to it? Are we,
So I would say typically our RFP cost for new clients starts at $15,000. I think, sorry, I'm getting yelled at. I turned it on. So I'll be honest here. Yeah, typically our cost for RFPs for new clients starts at $15,000. I think because of the relationship, we will not go near that high. We'll get this down as far as possible for you. Kind of two thoughts on that. One is you might be able to reach out to Mutual of America and see if they are able to assess these fees to the plan. I'm not sure if their platform allows for it. Again, every other platform that we work with would allow for that, like a one-time fee to the plan to pay for our fees. And then two, kind of ongoing, if we were selected to be hired ongoing to help you monitor these funds, the vast majority of the municipalities we work with have our fees built into the plan ongoing, so it's not a budget item as well.
I'll just reiterate, as the longstanding representative of Fiducian, that echoing Scott's comment, we'll obviously greatly appreciate the long tenure with the town, and we'll make the bid particularly competitive, and I don't think it would be an impediment to moving forward.
Appreciate that, and anything you could do. And as I said, I think that, from a timing standpoint, it's not necessarily something that we have to then hold over to February. We could potentially do a special meeting just to discuss that, and if we then choose to move forward with the RFP process and accept their proposal, we can do that just as a select meeting by itself.
I think that's a good idea, because if it has to go to the selectmen or the Board of Finance, I'd rather not wait an entire quarter and then go through the process.
We should have, by the latest, a week after Thanksgiving, the quote for you.
Okay. So we have the motion to move forward with a proposal, and it's been seconded. Is there any other discussions or questions? If none, all in favor?
Aye.
Any opposed? None. So the motion carries, and Scott, we look forward to put you to work over Thanksgiving to not be carving the turkey, you'll be carving the fees for us. So slicing the fee, yes. So sorry to ruin your Thanksgiving for a proposal.
Oh, it's more work for Chris than it is for me, so.
So I thank you for both of you for coming down and staying a little late for our meeting. Do we have any other issues or items to be brought before the committee?
Okay, motion to adjourn?
So we have a motion to adjourn. Do we have a second?
Second.
Then all in favor? Aye. So our meeting's adjourned at 9 o'clock. Thank you very much.